We are here at Lifestyle Trading 101 for yet another lesson on options. So under learn option strategy, we had the long call option strategy, but today we're going to talk about the out of the money call option. So the out of the money call option, well, it's basically an option that's out of the money. We're going to talk about the payoff diagram, basically how it's structured in comparison to where the stock is trading. All our examples use 100 as where the stock is trading at. And we're going to talk about the pros and cons, as well as what moneyness means, what happens when you change the price of the stock from 100 to 101, or from 100 to 99, how that affects moneyness. We're going to look at a standard options chain and talk about where we have to look to find the different types of call options. And we're going to talk about extrinsic value versus intrinsic value. We're also going to talk about specific option examples in the SPY S&P 500 ETF. We're going to look at various pairs where we have the same expiration but different strike prices and how that affects the specific return on capital when you buy that option versus another option. So we're going to go through 3 different examples of that and generally talk about the break-even point for the out-of-the-money call strategy. And of course, we're going to summarize what we learned. So back to the top, the definition of an out-of-the-money call is basically a call option that has no moneyness because the market price does not or has not yet exceeded the strike price. So when the stock is trading at 100, and the strike price is, for example, 105, then in order to be in the money, that 100 stock price has to move to the right past the 105 point in order to be in the money. As long as the market price or the stock price has not exceeded the strike price, then that's considered out of the money. So if you have a 105 strike or a 104 strike, 101 strike call, but the stock is trading at 100, that's all of those are out of the money call options. So if you compare a payoff diagram of an at the money call option versus an out of the money call option, well, basically an at the money call option is when the vertex of that kind of hockey stick call diagram vertex is at the same vertical space as the stock, which is at 100. So when the vertex of that call option diagram and the stock price all are the same, and in our examples we use 100, if it's at 100, that means you're at the money, and it's going to cost you some certain amount. That vertical distance between the horizontal call option red line and the x-axis, that's the cost of the option. Now, when we're dealing with out of the money call options, that's when the vertex shifts to the right, right? So when the vertex shifts from 100 towards, say, for example, 105, then the call option diagram becomes an out of the money call option, right? So that out of the money not only shifts to the right, but also shifts up a little bit, such that the cost of the option shows it's smaller, so that the spread between where we are and the x-axis gets smaller to indicate the cost of the option goes down when we have out of the money calls. So out of the money calls cost less, they're less expensive. They also have a vertex on that hockey stick payoff diagram further to the right. So again, at the money is kind of like standard, where the vertex intersects at 100. And then anything to the right, you move that kind of hockey stick diagram slightly to the right and to the up, and up. Then we have an out of the money call option. Now with pros and cons, the pro is that, well, out of the money calls are generally cheaper. You'll typically see something, less than 50 cents or $1 for one option contract. Whereas in the money options are almost always, a few bucks or more, typically over $3, for example. Out of the money call options are also much more explosive in terms of percentage gain on your capital if you time it right. So, the good thing is, they're cheap, and you could buy something for like 50 cents and it goes up to $1, and that's like 100% gain. But of course, when the market's not moving, then that 50-cent option decays towards zero. And it's going to move a good amount between now and expiration just to surpass your break-even point. Back in our diagram, 100 stock price and 105 out of the money call price, you got to go even beyond that, just like 106 or 107, depending how much you pay, beyond the 105 strike, just to break even. So the stock has to move quite a bit just for you to break even. And so that's one of the downsides with the out of the money call option. There's a low probability of success, and it's low because the stock has to move so much just to break even. Of course, you have enough time, then it's okay. But if you don't have enough time, your option is going to decay to zero. And these out of the money calls generally decay to zero faster than the other types of at the money or in the money options, because they have no intrinsic value. So, in this, we have a chart of intrinsic value, and you can think of this call option diagram, and intrinsic value basically being anything that where the stock exceeds the strike price. So if the stock price exceeds the strike price, then you start building this kind of intrinsic value. So you have moneyness and you have intrinsic value. But as long as the stock price is below the strike price, then you only have extrinsic value. And when you're dealing with out of the money call options, they only have extrinsic value. So for example, if a 105 strike call is trading at 50 cents, that 50 cents is all extrinsic time value. It has no intrinsic value. But a $99 strike call, for example, that's in the money, has $1 of intrinsic value, because it's $1. The stock price is $100, is trading $1 in the money. So let's take a look at the option chain. This is a standard option chain, and you have basically your strike prices going down the middle. On the left side, you have your call options. On the right side, you got your put options. Now, when we're talking about out of the money calls, well, we're talking about the strike prices that are higher than where their market is trading at. So if the market is trading, for example, at 208.5, then any strike price higher than that is out of the money. So where is that on the option diagram? That's on the bottom left. The bottom left portion of a standard option chain is where the out of the money calls are. The upper left is where the in the money calls are. So upper left is in the money calls, lower left is out of the money calls. Now, out of the money call options, you can think of them in terms of trading purpose, kind of like hot potato, right? You want the hot potato, but you don't want to hold it too long, because if you're caught holding it at expiration, you're going to lose all your money, especially if it hasn't moved. So you want, when you're holding that out of the money call option, you want the market to move. If the market's not moving, you're going to get burned. So that's basically one way to think about trading out of the money call options, because if you're just holding it day after day and you're looking to swing trade with an out of money trade, out of the money option, and it turns out the market doesn't swing in your favor, well, you're going to lose everything, right? However much you put into that out of the money call option, that's how much you're going to lose. And especially with out of the money call options, you've got to be right with the swing. Otherwise, you're going to lose. You can play safer with in the money call options. That way, they still have some intrinsic value when it expires. But if you're looking to swing for the fences and get that huge percentage return, out of the money options is the way to go. You just want to make sure that you don't hold too long. And when I say explosive out of the money options, what do I mean? Like, what kind of percentage moves are these OTM, out of the money options, capable of? Well, on one typical day, for example, the SPY S&P 500 moved like less than 1%. Yet, I have two examples here of two call options, two weekly call options. These are options that are expiring within the next 5 days or so on a Friday, and one of the options increased by 29%, whereas the other one increased by 43%. Now, well, first, that means that both are pretty good percentages, percentage-wise compared to the underlying. The underlying moved less than 1%, yet the option moved 29% and 43%. So, I mean, that's the power of leverage when you're dealing with options, particularly short-dated options, weekly options. Now, why is it that one of them was 43%, but the other one was like 13% less at 29%? Well, they both expired on the same day, but one of them was a 225 strike, and the other one was a 224 strike, right? So the 224 strike was closer to in the money. I'm not sure whether it was in the money or at the money or slightly out of the money. But, between the two, the higher strike call, the 225 call, is more out of the money. And so the further out of the money in general, the bigger the percentage return on your capital. So that's, even though the strike price is just one, that resulted in a difference of 13% difference in return on your capital. So another example is when we go 1 week even further out. So these are considered 2-week options, right? So, you have a 224 strike call and a 228.5 call. So now we have a wider difference in the strike price. The difference is 35% versus 23% in terms of changes for that day. So in this case, because you're further out, the difference in strike prices yields a smaller kind of difference. So it turns out that when you're dealing with really short-dated options, even a difference in one strike price is a pretty big difference. But the further out you go, like, the difference becomes a little bit less. Still a difference, but a little bit less. And the third example is, we got the same strike. It's the same out-of-the-money call option. Let's say 228.5. And, the difference is one expires on a Friday and the other one expires on a Wednesday right before. It's a 2-day difference. Now, the difference in terms of percentages, one was 35.62%. That's the Friday expiration. And then the Wednesday expiration was a little bit more at 37.5%. So that the difference is not due to the strike price, because they're both out of the money at 228.5 strike. The difference is one's Wednesday and the other one's Friday. The Wednesday one's going to explode a little bit more than the Friday one. Why? Because the expiration date is a little bit closer to where we are. So in general, the shorter dated option will have more gamma, they call it. That's an option grade gamma. A little bit more explosion value than longer dated options, even if the difference in terms of time is just 2 days. Now, we mentioned before that out of the money call options are low probability trades. And they're low probability because the stock has to move so much just to break even. If we look at a 105 strike call, the break-even point is beyond the 105 strike call by the amount of the cost of the option. So if the cost of the option is 50 cents, your break-even point is 105.5. So that that's a from $100 stock, that's $5.50. That's 5.5% that the $100 stock has to move just for you to break even. You don't even start making profits until after that. Of course, once you start making profit, it starts growing pretty quick. But if you don't go past that 105.5 strike by expiration, your call option is going to go to zero. You're going to lose the entire principal. So these out-of-the-money calls are, again, like hot potato. They can explode in value when they move quickly in your favor immediately. But if they don't, you can risk losing all. So there you have it, the out-of-the-money calls. And to learn more, make sure you sign up on our email list on our website, lifestyletraining101.com. This is Silver Surfer, and I'll see you guys next time in our next lesson.